where you should place your investments. Now, before you continue on, I'm not your financial advisor, and if you're gonna make financial decisions, please speak with a certified financial advisor. But these are some questions that you can personally ask your financial advisor, and maybe these ideas will help you on investing in the future. Why should you invest? Investing is a good way to have your money work for you and over time. Of course, holding your money or putting your money in the bank are safe strategies, but because of inflation, all that money loses value over time. Just look at back in the year of 2000 and compare to now. So before you invest, there are a few things to consider and take note so you are not only relying on these investments if emergencies happen, such as medical emergency or when life takes a dive in general. With that being said, the first thing is to build an emergency fund. This is a very important dedicated saving funds that everyone should build to cover the costs that may happen over time, such as what I mentioned earlier, medical emergency or a job loss. So this dedicated fund should be around 3 to 6 months of your expenses, or could be more depending on how long it takes for you to take action to move on with your life if something happens. This really depends on you. These funds should be liquidated or liquid, meaning that cash should be used for urgent or unplanned expenses. You never want to spend these funds on non-urgent matters such as vacations or gifts. And I can see a lot of people wasting these funds. Hopefully you do not become one of them when you are investing. Secondly, you want to pay off all your high interest debts. Prioritize paying off all your high interest debts as they will eat into your investment profits. High interest debts, you look at things such as credit card debt, you look at your credit card statement, and always pay more than a minimum so you will pay less interest overall. Credit card companies make more money when you are careless with your money and expect you to pay the minimum that you pay them more overall because of the interest. So credit card companies are crooks in this sense. But overall, knowing your time on the horizon may be crucial as everyone has different investment goals. You and me have different investment goals, different plans of what you want to do with investments. It ranges from retirement, paying your kids, college education, to saving up for a home down payment are all different goals. So you need to know the funds you're investing and know which investments to choose to manage risk so you will meet that goal. So with investing in the long term, starting early is one of the biggest advantages anyone can have as you have more time to generate more profits. And also, the most important one, you can afford to make mistakes early on in your career. So if you think about it, if you make mistakes when you're 25 versus making mistakes when you're 60, there's a big giant difference how you will intake that. So when investing, always diversify into different sectors. What if you put all your money into let's say a single stock or a company and it goes in bankruptcy? For example, maybe Silicon Valley Bank threw your money in there and it went poof. Then it loses all its value. So a diverse portfolio helps you prevent that from happening so you do not lose all of your money. It is a method of managing your risks in order for your portfolio by diversifying between multiple asset classes. Next one, the most important one, is asset allocation is very important. For example, allocating your total income to 60% stocks and 40% to bonds. That is one method. Many other methods out there. It depends on you, how you want to do it. Owning stocks from multiple industries, you got ranging from companies that have large to small market caps. Choosing the right asset allocation helps to maximize your returns. It helps you to get the highest returns for the amount of money you are willing to risk. And for example, let's look at Forbes investing. What is an asset allocation? So taking a look of someone with low versus high tolerance.
So there are 3 types of investors: investor A, investor B, and investor C. So investor A, 22 years old, 40 years to retirement. They have a high risk tolerance. So this investor is interested in growing their retirement savings over the next 40 years. They know the market will have ups and downs, but are more interested in holding investments that will offer the potential for a higher rate of return. They will also want to diversify their portfolio that allows maximum exposure to the stock market and its historically high rates of return. So this is what a typical portfolio they might have according to Forbes: 80% stocks, 40% large cap stocks, 30% mid cap stocks, 30% small cap stocks, 15% bonds, and 5% cash. Now moving down to investor B, 40 years old, 15 years to retirement, moderate risk tolerance. So in this case, this investor don't really have the time for luxury, but their portfolio changes up a bit. So in an ideal situation, Forbes say they will have 60% stocks, 60% large cap stocks, 20% mid cap stocks, 20% small cap stocks, 30% bonds, and 10% cash. And you'll notice throughout this trend that they'll change the amount of stocks they'll buy. They'll change how they will liquidate it. They will hold more cash. It really depends on each person. Now, if you look down to investor C, they're 60 years old, beginning retirement now, which at this point, they will have a low risk tolerance. You're getting your golden age of years to the point that you want to retire and live out the rest of your life. So this investor is celebrating the end of their working years and looking forward to using their retirement savings to explore new horizons. Losing money isn't really an option since money they have already saved up needs to last for the next 20 or more years. And this is, unfortunately, like the American dream, that which most people ideally want to be in, but it's not easy to achieve. So when they diversify their portfolio, it'll look similar to like this, which they have 30% stocks and they have 100% large cap stocks, along with 50% bonds and 20% cash. And looking out these three types of portfolios, what type of investor you want to be. Personally, myself, I will prefer investor A. And if you're in the younger years, let's say you're in my audience, you're in 20s, 30s, maybe like you're just starting out, maybe you're 15s or 18s, maybe then you want to take a higher risk. Because if you look at, as I mentioned in previous videos, is that if you look at how gasoline prices, how the cost of products throughout the years, let's say from the year of 2005 until now, 2024, look how much gasoline has risen throughout the years. And look how much goods and services that has risen up the years. Maybe, let's say you go drink boba milk that used to cost about 50 cents a dollar. Look at now today, $4 to $5, maybe even $8 to $10, depending on certain places. So if you put it out this way and look at historical data, stocks usually and businesses usually are worth more, or basically you can thank inflation into that, which they cost more later on down the line. This is how the stock market works in the United States.
As shown, differing time horizons and risk appetites dictate how investors choose to allocate their assets. If that becomes a headache to think about and do, the next best option would be invest in an index fund. Speaking of index funds, an index fund would be like the S&P 500. The S&P 500 also offers an instant diversification and tends to outperform most actively managed funds after fees over the long term. It is also one way to keep costs low. And S&P 500, if a lot of people don't know, is basically you're buying into fractional shares of the top 500 companies during the time you are purchasing that stock. So having fees and taxes is just another burden. Let's take, for example, a $100,000 investment earning 7% a year with no fees. That account could be worth more than $575,000 in 25 years. Let's ask yourself, but what if you pay a mere 2% per year in fees? That would result in a worth less than $350,000. So fees are killers. And the next killer is taxes, which is my specialty, which will eat into your return, so you may want to keep your highest tax investments in the tax shelter accounts. These accounts legally store assets so that your current or future tax liabilities will be minimized. You want a mix of taxable, tax-deferred, and tax-free investments so that you may be able to pull it from retirement when time comes. Like, for example, long-term and short-term capital gains tax. The longer the duration you keep your investments in general, the more returns you will receive due to lower taxes. This is also taken considering how much you earn based off the IRS for single filers. They are taxed at 0% rate if they make less than $44,625 after a year in your investments. This, by the way, doesn't include state income tax, which you will depend on which state you live on, or depending where you watch this video. Always review your investment strategy regularly, as things may change periodically. You want to make sure that your allocations are on point, as in hot markets. Stock markets might outgrow their intended portion and need to be pared back. So avoiding this may result in taking more risks with your money, which you intend. Next is long-term investment. It is all about focusing on your long-term goals and ignoring the busy and active nature of markets, especially the mainstream media that covers them. And you all know what I'm talking about. This means buying and holding for the long haul. Always consult with your financial advisor for your investment plans. So what do you guys think about this? Should you basically actively manage stocks, or you should passively manage stocks? Personally, myself, I would passively manage it because you have a lot of other things to do, and investment portfolio is basically a backup plan for you to make money, or you can, let's say, act as a second hand to help you up and take your money to the next level. For example, buying rental properties, buying stocks, buying bonds. There's a lot of other options out there. And as usual, make sure to click the like button down below and the subscribe button, and I'll see you guys next time. Peace.